Welcome, everybody, to today's podcast. My name's Andrew Wilkinson. I'm delighted to welcome to the program today from London fund manager Stephen Yu. How are you, Stephen?
Very well, Andrew.
Stephen is the Chief Investment Officer and Managing Director at Blue Whale Fund over in London. That's a fund that is available on the Interactive Brokers platform. So, Stephen, I've been reading a lot about you from your website, and I'm intrigued by the approach and the investing style. And one of the standout things is, first of all, you're a global investor, so you're a very good client to Interactive Brokers because you're doing what we anticipate that all of our clients would like to do, which is trade around the world. Now, your investing style distills the universe of investable stocks down to just 25 names that you believe have the potential to grow and become more profitable over time. As a fund manager, does that approach help you see the wood for the trees? Is it a more efficient approach rather than adopting and having to look after a larger universe?
Thank you, Andrew, for that question. I think that goes back to our investment philosophy or how Blue Whale started. And obviously, the name of the fund is called Blue Whale Growth. And I got the inspiration from the Natural History Museum in London and basically symbolize significant outperformance. And I think as in today's world, that has been a lot of challenges or the rise of the passive, and a lot of investors can actually buy a basket of stocks quite easily. And I've been reflecting about when we wanted to launch our own fund 7 years ago, that we need to do something very different. So by doing something very different means that you need to firstly maybe invest only into a handful of stocks. In our case, would be between 25 to 35 stocks. And the other thing on top of that is if we can manage to perform first significant level research in terms of doing a lot of more things behind the scene than our peer group or maybe the market in itself, then we have a better chance of delivering significant outperformance. I think that is kind of the story in a nutshell, in a way that ultimately, if we ended up holding too many stocks, I think the level of research we can end up having would be probably immaterial relative to what has been priced in the market. So then ultimately, it's a choice that we want to probably maximize our expertise into a handful of stocks. And then at the same time, we have proved that we could be able to deliver much better performance than our peer group of the market in itself.
Stephen, as I was reading through a lot of the commentary on the website, a word jumped out at me. The word is transcend. Your whole approach, your philosophy revolves around this word transcend. Let's explain that to the audience, please.
So we do what we call the transcending companies. And the way that we define them is they are very idiosyncratic. Obviously, when we first started back in 2017, you have recalled what had happened since then. We have gone through a mini recession or slowdown in the US back in 2018, 19, followed by pandemics, interest rate coming down, QE, government handing out paychecks, and the inflation interest rate going back the other way around. And then we have two conflicts in Ukraine and Middle East. And there's a lot of macro uncertainties going on. And I think one of those things that is probably going to become a part of our day-to-day, including what Trump is going to do in the next 4 years in terms of trade tariff, etc., is there's going to be a lot more uncertainties in the macro domain or in the backdrop of the market environment. And of course, from a bottom-up stock picker perspective, what we really want to do is to find companies that might be able to transcend some of this macro uncertainty. So in a way that they're not so in sync or being sensitive to what Trump might be doing or what the interest rate might be doing. And ultimately, in that case, you would need a company to have some idiosyncratic drivers. So for example, when we first started back in 17, the first couple of years was very much related to digital transformation and those opportunities like e-commerce, digital payment, digital advertising transcended the pandemic. We all know that we ended up spending a lot more time using those services or products during the pandemic. And for the last couple of years, while the world have actually gone worse in shape in terms of the geopolitical uncertainties, but artificial intelligence transcended the macro uncertainties in a way that enterprises continues to spend more money despite the fact that the outlook for the economy is a bit more uncertain.
So, can you define some of the global megatrends you're trying to take advantage of?
So there are a couple in the fund. We do artificial intelligence, which we can come back onto that at the moment we would very much prefer AI infrastructure companies such as Broadcom, NVIDIA versus the Mac 6, Microsoft or Apple or Amazon or Google, which we are very much underweight or not own many of them. I think outside of artificial intelligence, we do like some other idiosyncratic opportunity that might be a bit different to our technology exposure. One is the US sports gaming. So we have a company called Flutter, and our audience might be familiar with the sub-brand called FanDuel. And together with DraftKings, these two companies control over 80% of the market share in the US sports gaming. And from what we know is American love sports. At the same time, the GDP per capita is a lot higher than the rest of the world. And of course, then when you look at the states by state legalization of sports gaming, at the moment, it's about 50% of the states or population having access to sports gaming. So this is very idiosyncratic in a way that is not so much depending on what Trump is going to do because it's done on a state by state basis. Secondly, it's probably not overly dependent on what's happening outside of the US, for example. So that is quite idiosyncratic. The other one that we like is very different as well. It's called Philip Morris. People might be familiar with it. But what has been very interesting about this company is about the transition into smoke-free products. So through IQOS, IQOS, at the same time, they acquired Swedish Match, which now we have seen the nicotine pouches. And so they're doing quite well in terms of transition. At the same time, the idiosyncratic bit was since Philip Morris spun out from Altria back in 2008, they were everywhere outside of the US over the last many years. But recently, they got the license to market their IQOS product back to the US. So that is quite idiosyncratic. So potentially, they might be taking some market share from the local players in the US. So that we like. And lastly, I would just mention that we also invest into healthcare equipment companies such as biologics. So within the fund that we have Danaher and Sartorius, and we very much like the biologics development over time, similar to the COVID vaccine was done through biologics, that we could have personalized medicine in time.
So let's bring it back to artificial intelligence. And I want you to try and respond to this. The prospects for AI in light of three major things that have happened in the last 4 weeks, let's call it. Project Stargate, which was announced in the early days of the Trump administration, the DeepSeek initiative from China, and what's happening in current markets is the impact of the announcement from the Trump administration on tariffs. What changes or doesn't change the background for or the prospects for AI?
I think the most important question that investors should be asking themselves, which is also a question that we constantly challenge ourselves, is how much do you believe in generative AI is going to change the world, our day-to-day, or even in the enterprise domain? Our belief that is we are in the very early innings of that development. So we have seen a lot of AI applications such as ChatGPT, Google Gemini, image generation through Firefly, Midjourney, or even like you can now transcribe a conference call in real time and summarizing an essay. There's a lot of things I can do, but we think like a lot of these are just at the early innings. So if you do believe that we have more things to come, such as AI agents, etc., a lot of these developments so far, such as Stargates, have become a national interest that every country want to embrace a bit of a sovereign AI so that you're not dependent on another country providing you the capability. So that is probably going to happen, not just in the US, but at the same time in Europe or maybe in Asia. And at the same time, what DeepSeek has managed to introduce to that equation or contribute to that equation is there has been two bottlenecks in our industry before DeepSeek started the revolution. One was the cost of training a model and ultimately the price that people would need to pay for the service. And secondly, would be the energy intensity. So what DeepSeek has managed to showcase is you can actually use many fewer GPUs to do the trainings and get to a very similar output to what ChatGPT might have delivered. At the same time, the energy intensity is a lot lower. So what we believe on the back of this revolution is more startup would be able to come in to develop more AI applications. So it's no longer confined just to the big tech. Because previously, if you haven't got the access to billions of funding, you would not be able to deliver AI application that could be a market fit product. But nowadays, DeepSeek have showcased that you can actually do it with millions, not billions. So this is very positive in terms of development, and we are going to welcome many more applications to come to challenge the incumbents. And also it's very good for consumers and enterprise users. I think the last point about tariff, this is a bit tricky. Obviously, the one thing that we do like about the semiconductor equipment industry is silicon sovereignty. So for example, within the fund, this is related and not just related to AI, is semiconductor equipment companies such as Lam Research or Applied Materials. As we all know, on the back of 2022, we had the CHIPS Act in the US, followed by a similar European Act in Europe. And in total today, there are over 400 billions worth of commitments to spend to build foundry outside of Taiwan. So you have many foundries being built in the US, at the same time in Europe, in Germany, in Japan, in South Korea, etc. So what it actually means is you want to localize the production, right? Like you want to de-risk away from Taiwan so that if tomorrow Taiwan is no longer autonomous, you can still have access to those chips. So I think in terms of the tariff, as far as semiconductors or GPU are concerned, I think that journey already started since the CHIPS Act in 2022. And that's going to continue. And hopefully maybe Trump will accelerate that development. And I think it's actually very helpful to the industry in itself or the semiconductor equipment companies who are selling you the mission critical equipment.
Stephen, how important is it to you to remain a global investor? You're from London, you're investing a lot into the United States, but your focus is global. How important is that for the fund?
It's very important, I would say, even though that going back to the last 7 years, we have had a bias towards North American companies. So on average, we probably would have about 60 to 70% exposure to American companies over the last 7 years. Of course, the composition of those opportunities has been very different 7 years ago compared to today. But it just happened that most of our opportunities that we really like ended up to be American companies.
Hmm.
I think from my perspective, looking back to how the fund was started 7 years ago, was that I truly believe in a global approach in a way that while we do have a bias to North American companies to date, I don't want to be limited or I want to maintain my flexibility that in time, if maybe Trump is creating too many chaos or maybe Trump is no longer running and we have a different administration, maybe things could be different, right? So from an investor point of view, I'm indifferent in terms of where the opportunity sets are. I'm very happy to invest into British, European companies or even some Asian companies. So as far as an investor is concerned, you want to be able to explore different opportunities from a bottom-up perspective. But I would say that so far, those opportunities has been very much to do with the North American companies, which we still like. But over time, that could change. As we all know, the market goes in cycle. And of course, even though we still quite a few names in the US, that you can start to see the valuation gap between the American counterparts versus European companies has been probably getting bigger and bigger. And a lot of people are making a commentary about, oh yeah, the US is very much overvalued compared to the European counterparts, even though that we can see the rationale why that might be the case, just because the quality of the American companies, at the same time, the growth opportunities are a lot higher compared to European companies. But at some point that could change. There's always a price that you're willing to pay for premium of some of these prestige assets. So then if the price continue to widen, then maybe you want to consider something different, just because ultimately we are trying to maximize our investors' return through investing into the best opportunities, and not just the company need to be taking market share from other players, gathering more spending from consumers, enterprise users. But at the same time, the price that you pay for those assets is very important in terms of the long-term return profile of the stocks.
Do you ever take a negative view of the overall market and decide, no, we need to lighten up the load? And if that happens, then what does it look like? What do you do?
I think the answer is yes or no. And just because we run a long only equity strategy, so this is not a multi-strat fund, like there's a limitation of what we can do on a very high level. We can raise some level of cash, but it's not like we can go into 90% cash and not have anything. This is a long only strategy. And I think what we say to people is the recommended time horizon to invest into a fund like us would be about 3 to 5 years. So if you are investing much shorter time horizon, maybe you shouldn't be considering such a strategy, just because the way that we think about things, how we manage the fund, how we size opportunities would be taking a 3 to 5 year view to start with. I think on a very high level that this is one of those things that investors have to consider themselves, because I've been doing this for more than 20 years now, and you would have followed the market very closely, that there's always a lot of uncertainties. There's always the speculation about, oh, the market's too expensive, or maybe there's going to be a bubble, there's going to be a crash. But when you really look at the long-term trend of, let's say, the American stock market, it's not a given that it will repeat in itself, is the long-term trend is going up on a
Mm.
very high level, right? So if you can time the market quite well, which I don't think many people can do that consistently, then you probably make more money than what the S&P could have given you, right? I think the S&P annualized return, let's say about 10% on average, maybe over the last 30 years or so. If you can time the market, you might be able to get 13, 14. But if you time the market incorrectly, you might actually got a lower return because you miss out the kind of the bull market, or maybe you have sold too early. So from our perspective, because we invest into companies and we feel the quality of the company give us a comfort, like despite that we have gone through 2022, the share price might have been down a lot, but at the same time, we have confidence about the earnings power of our company. So you stick with them. Of course, whether you care about the short-term volatility, oh, I don't like to see my portfolio down 10, 20%. I think maybe then you shouldn't be involved with equity funds or equity to start with, just because there's always volatility. So you should not get panicked. I think when you want to panic about is that the company or the asset that you invest into are very low quality that may then end up with a permanent loss of capital, which means that you cannot get your money back. But if you're just saying to me, oh, Microsoft share price is down 10, 20%, just because the market was a bit uncertain, I think that is fine, because Microsoft ultimately is a business to be around for many years to come. So I think that is a choice that investors have to make themselves. But for us, we try to do on the margin, but I wouldn't say that is too significant.
Thanks to Stephen Yu, CIO and Managing Director at Blue Whale Growth Fund in London's Mayfair district. Thanks for joining me, Stephen.
Thank you.
And to the audience, remember to get updates on all of our episodes by subscribing wherever you download your podcasts from.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Blue Whale Growth Fund is not available to clients of Interactive Brokers LLC,